Hello, welcome back to another video. In today's video, we'll explain what is price imbalance, known also as fair value gaps, when and how to use it. Price imbalances are one of the core concepts behind how markets actually move, but they're often oversimplified and misunderstood. A price imbalance happens when there is a strong mismatch between buyers and sellers, causing price to move aggressively in one direction. During that move, not enough transactions occur at certain price levels, creating what we call an inefficient zone or a fair value gap. In simple terms, price moved too fast and the market didn't have time to properly match orders. These imbalances matter because markets are driven by liquidity. When price leaves behind inefficiencies, it often comes back later to rebalance those areas, either to fill orders or to continue moving with better participation. The most common way traders identify an imbalance is through a three-candle structure. You have a strong impulsive candle in the middle and a gap between the high of the first candle and the low of the third candle. That gap becomes the imbalance zone. But here's where most traders get it wrong. Not all imbalances get filled, and not all reactions from these zones lead to profitable trades. This is not a standalone strategy, and treating it like one is a fast way to lose money. What actually gives this concept an edge is context. You need to understand the higher time frame trend where liquidity is resting and how the market is positioned. Tools like open interest, funding rates, and liquidation levels in crypto markets can significantly influence how price reacts around these zones. For example, an imbalance that forms after a strong breakout in a trending market is very different from one that appears in a choppy low volume range. In practice, there are three main ways traders use imbalances. The first is continuation. If price breaks out of the range and then returns to the imbalance, it can act as a support or resistance zone for trend continuation. The second is a fake breakout. Price moves through the level, fails to hold, and then reverses back inside the range. This often traps traders and creates a move in the opposite direction. The third is a liquidity sweep. Price takes liquidity above a high or below a low, taps into an imbalance, and then reverses. This is one of the most powerful setups, especially when aligned with higher time frame levels. However, in today's market, especially after 2022, this concept has become extremely popular. Because of that, the edge has been reduced on lower time frames. There is more noise, more manipulation, and more retail participation trying to trade the same patterns. That said, imbalances still work, but mainly in the right conditions. Higher time frames, strong trends, and high volume sessions like New York are where they are most reliable. Don't forget to like, comment, share, and subscribe for more videos.